Hi everyone. In this lecture, we are going to discuss about break-even analysis and its applications. Myself, Dr. M. Kondalrao, Associate Professor, Department of Management, ACE Engineering College. After completion of this video, we will be able to understand what is break-even analysis, what is break-even point, what are the various components of break-even point or analysis, what are the various applications of break-even analysis, graphical representation of break-even point, significance of break-even analysis and its applications in various industries. Now, let us see what is break-even analysis. So, break-even analysis is one of the important economic tools which is used to determine the cost structure of a company or the minimum number of products need to be produced and sold to cover the total cost of the production. By using this tool, every business can understand what is the minimum number of units to produce in order to determine the break-even point. It is also known as the cost volume profit analysis, or also called as CVP analysis, which helps in examining the relationship between the fixed cost, variable cost, output and the total revenue of the business in that particular period in which the break-even point can be determined. And coming to the break-even point represents the volume of production where the total cost of the production is exactly equals to the total sales revenue, resulting into no profit or no loss situation in the business. It means that where the company's total cost is exactly equals to this total revenue, that is the point is said to be the break-even point. At that break-even point, the companies get no profit or no loss. If output of any product falls below this break-even point, that is loss, and if the output exceeds the break-even point, there is a profit in the business. So it depends on the targets of the business. Business persons can maintain such situations. Break-even point enables the financial manager or the economist to study the general effect of the level of the output upon the income and expenses upon the profits. It is very important as well easy economic tool which will use by the economist as well the financial managers in the business in order to fix the targets in terms of number of units to produce as well in terms of value or the revenue that is to generate by the business. And coming to the components of break-even analysis, there are many components which will affect on the break-even point or the business profitability, whereas there is very important components which we will consider at the time of determining the break-even point when using the break-even analysis, such as fixed cost and the variable cost. These two are the major components generally economists or the financial managers can consider at the time of determining the break-even point while using the break-even analysis. Now let us see what is fixed cost and what is variable cost and what are the examples of these components. So fixed cost is the cost which will incur in a business unit which does not depend on the volume of the production. It means that there is no changes or remains constant, which will not change according to the level of production, which is also called as overhead cost or also called as indirect cost, which is not directly affect the volume of production or volume of production does not directly influence the fixed cost whether to increase. Whereas coming to the second component of break-even analysis, that is variable cost. Variable cost is the cost which will increase or decrease or fluctuate according to the level of production. Means that if there is increase or decrease in the level of production in terms of units, the cost will change, that is known as variable cost. The examples for the fixed and variable cost are here salaries, rents, depreciation, income taxes. All these are comes under the examples of fixed cost which will not change according to the level of production. Irrespective of level of production, irrespective of units, here the fixed cost is remains constant. Example, salaries. So even though there is no production, we need to pay the salaries to the employees at the end of every month, unlike a variable cost. In case of variable cost, the examples are cost of raw material, cost of packaging, cost of fuel, gas, water, fuel, and all these are the variable cost, which is also called as direct cost, which will directly affect the total cost of the production. If there is a production in the business, the variable cost will vary. Let us take an example here, raw material. If there is a production, we need to consume the raw material, hence the cost of raw materials may increase or decrease in terms of cost. So these are the major components of break-even analysis we need to consider at the time of determining the break-even point. Now let us see the assumptions of break-even analysis. So if we want to determine the break-even point using the break-even analysis concept, we need to assume certain assumptions. Otherwise, the break-even point does not hold good in any business, such as, so all the cost can be separated into fixed and variable components. Whatever the cost that we are incurring in terms of cost must be in a position to classify or divide or separate into fixed and variable cost. In this case, we will ignore the semi-variable cost, and fixed cost will remain constant at any level of production, as we discussed in the previous slides. Fixed cost is the cost which will remain constant at any level of production, which does not change according to the level of production. And the variable cost will change according to the level of production. Here, the general prices of the production or the general prices of the inputs will not be changed, means the variable cost will be changed. And selling price of the product will remain constant. Whatever the price we are fixing during the break-even point period, the selling price remains constant, which cannot be changed irrespective of level of demand in the market or the cost of the production in the business. Product mix will remain unchanged. Whatever the products mix that we are following during the period in which the break-even point is determining, the products mix will be constant, and there is no opening or closing stock. This is very important assumption of break-even point. Whatever the products or units that we are producing during the period in which the break-even point is calculating, there is no closing stock, means that whatever the products that we have produced must be sold in the market, means there is no closing stock. If any stock left in the business during that period, the break-even point does not hold good. And the most importantly, there will be no change in the general price levels of inputs. In terms of raw material, fuel, water, gas, whatever the inputs that we are using or consuming for producing the product, the prices of all these inputs will not be changed. This is also very important. So they are the some of the assumptions that we need to consider at the time of calculating or determining the break-even point by using the break-even analysis concept. Now let us understand the break-even point chart or the graphical representation of a break-even point. See, if we want to determine the break-even point, we may calculate the break-even point by using the numerical calculations or also graphical representation. Now let us see how the break-even chart can be constructed by using the various variables. The horizontal axis that we are using here called x-axis, and the vertical line that we are using here called as the y-axis. On x-axis we will take the number of units produced and sold in the market during that period, and y-axis reveals the total cost of the production or the total revenue generating by the business, and the horizontal line which is parallel to x-axis called as a fixed cost curve, and the curve which is floating from left to right upward, which will start at fixed cost, is called as a total cost curve, and the curve which is floating from left to right upward, which will start at origin, called as a total revenue curve, and the point where the total cost curve is intersecting the total revenue curve is known as break-even point. This is a very important point that we are determining. Means here the point occurred where the total revenue curve is intersecting the total cost from the below, that is known as break-even point. Here the zone below the break-even point is loss zone, and the zone above the break-even point is the profit zone, and the angle which is forming at the break-even point is known as angle of incidence. So here, based on the angle of incidence also, we will estimate the profitability position of the business during that particular period. More the angle of incidence, higher the profitability, right? And here, at the break-even point, this is OQ, called as break-even point in units. At the break-even point, OP is the break-even point in terms of cost or in terms of revenue. And the area between OQ is called as break-even point in units. The above the break-even point called as margin of safety. Similarly, here the area between the x-axis and the fixed cost curve is a fixed cost, and the between total cost and the fixed cost curve is the variable cost. Now coming to the significance of break-even analysis. Here the break-even analysis can play a very important role in any business in various areas. So these are the some of the points that we have considered to understand the significance or the importance of break-even analysis. The first one is determine the volume of products to be sold. Yes, break-even analysis concept significantly plays a very important role in determining the volume of products to be sold in the market in the future, so that accordingly the business people will estimate what is fixed cost, what is variable cost, what is the profitability, what is margin of safety, and so on. So accordingly they will calculate break-even point in order to determine the losses, and deciding the budgets and the targets. Since the fixed cost, variable cost, selling price, and also the break-even points known by the people, they can easily decide the total budgets required or the total capital required to initiate the production, as well the targets in terms of units to produce, in terms of margin of safety, and in terms of revenue. And cost control. Since we know the fixed and variable cost in the future that we are going to incur by using the break-even analysis concept, we can easily control the fixed cost, variable cost, as well the total cost of the production. And designing of price strategy. As we know the break-even point in terms of units as well the break-even point in terms of value, we can easily fix the selling price according to the level of production, according to the desired profits, according to the policies and conditions of any organization. Now coming to the applications, this is very important area where the break-even analysis concept play significant role. That is, in case of planning in new businesses, generally this break-even analysis concept is playing a very significant role in startups. Here, new businesses have a lot to plan before they introduce the products and facilities and start manufacturing goods for sale. So if they want to facilitate all the facilities in terms of infrastructure, they will use this break-even analysis because they do not have the prior experience in order to implement in practice. Hence, this break-even analysis concept will help to the newly startup, and it is also play a very significant role in introduction of new products. If the company wants to introduce the new product along with the existing product or in place of the existing product, this break-even analysis concept will be helpful, because here already we are producing some products. Due to some reasons, we are planning to introduce another product. Since we are able to estimate the fixed and variable cost and also the selling price, we can easily take the decision whether to introduce a new product in the business. So here in this case also break-even analysis can be helpful, and it is also applicable in change in business model. See, sometimes due to the pandemic nowadays, here people are incurring many losses in their businesses. So existing business may not be profitable. Therefore, they are now decided to change their model from, let us take an example, wholesaler to the retailer, or retailer to the wholesaler, or wholesaler to the distributions. So while changing the model of the business, this break-even analysis can also helpful determining the total cost of the production, determining the profitability position of the business, and is also used to determine the revenue of the business. So change in the business model will most effective in terms of total cost of the production. So to avoid the losses, the break-even analysis concept can be helpful to the businesses. Now let us see very simple formulas that we will use in break-even analysis, such as break-even point in units can be calculated by using the formula fixed cost by selling price per unit minus variable cost per unit, and break-even point in value, this is measures in terms of rupees or in terms of currency, that is fixed cost by selling price per unit minus variable cost per unit by selling price. It is also calculated by using the formula fixed cost by PV ratio. These two formulas, these two techniques are very important at the time of determining the break-even point. If we are able to, or business people are able to determine these two values, break-even point in units and value, then automatically they can avoid the losses. Now let us see one simple scenario how to calculate this break-even point by using certain data. If you see here, Mr. Ravi would like to start a new startup for manufacturing computers with certain assumptions. Calculate the minimum number of computers to produce and sell to cover the total cost in order to suggest to Ravi whether to manufacture. So the assumptions are fixed cost 50,000 rupees, variable cost per unit is 20, and the selling price per unit is 40. So they are the three assumptions that he has made before starting manufacturing computers. So based on this data, Mr. Ravi would like to know how many number of computers he need to produce in order to attain the break-even point. Since we know the formula for calculating the break-even point, that is break-even point equal fixed cost by selling price per unit minus variable cost per unit. That is the technique which will be used by Mr. Ravi to calculate break-even point in order to take the decision whether to initiate the manufacturing process. So if you apply the formula fixed cost by selling price per unit minus variable cost per unit, the total 2500 units is the break-even points. It means that he must have to produce 2500 units to get the or attain the break-even point where there is no profit and no loss. It means that whatever the cost they have incurred, he has incurred in manufacturing computers will be recovered by using the activities. And also we can calculate break-even point in terms of value or currency by using the formula fixed cost by selling price per unit minus variable cost per unit by selling price per unit, where the break-even point value equal to 1 lakh rupees. It means that either he need to make a target that is as 2500 units, or he need to make a target as to generate 1 lakh rupees as revenue in order to attain the break-even point. So if he generate revenue 1 lakh rupees, means that he is in safe. There is no profit, no loss. If we increase the manufacturing computers more than the 2500 units, that is margin of safety. If he is produce less than the 2500, is a loss to the business. So apart from this, we have different scenarios in businesses. That is, in case of the price of the product change. See, while producing the product, suddenly due to various reasons in the market, there may be a change in the cost. Since the cost is increasing gradually, we need to increase the selling price also. So in case of the price of the products change, we will calculate the break-even point. Accordingly, we will change the target of break-even point in terms of units as well the value. Also in case of price of input factors, see, whatever the price input factors that we are using in terms of raw material, in terms of fuel, gas, water, or any other inputs, if any changes occur in the prices of input factors, we will also calculate break-even point by using the changes in input factors. In case of predetermined profits, see, sometimes we may have a target to generate the profits. So that is what called desired profit. If we have desired profits, accordingly we can calculate a break-even point. We can make the targets for producing the products in terms of units, or sell the products in order to generate the revenue also. In case of predetermined targets in terms of units, so if we have desired production, accordingly we can calculate the break-even point in order to avoid the losses. So this is the beauty of break-even analysis concept. Whatever the changes happened or occurred in the business, we can easily apply the break-even point, which can be applied in the business to avoid the losses in order to attain the break-even point. So this is one of the most important concept of economics, which will help guide to the business people, especially newly startup, to avoid the losses to determine the break-even point or attain the break-even point. I hope all of you understand the concept of break-even analysis. Right? Thank you.